Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about GREENTOWN MGMT interim report. GREENTOWN Management Holdings Company Limited provides various businesses and services, including project management, services property development management for commercial projects resettlement, housing property development for government public infrastructure project management, for government construction design, and consulting services, other miscellaneous services. The stability of GREENTOWN Management Holdings' stock price over the past year can be attributed to several key factors. The company's share buyback program has helped reduce outstanding shares and signal management confidence, while its high dividend yield has attracted income-focused investors. Positive analyst upgrades and outlook have also contributed to the stock's resilience, with CICC upgrading GREENTOWN Management to an outperform rating. The company's stable volatility and resilient business model, which focuses on project management services in China, have further supported the stock price. Additionally, the announcement of solid 2023 annual results provided a positive backdrop for the stock during part of the past year. While some analyst adjustments introduced negative sentiment, these were offset by the positive factors mentioned above, preventing a significant downturn in the stock price. The primary drivers of revenue growth or decline are multifaceted and influenced by various market and industry factors. Revenue growth is primarily driven by countercyclical sales growth, steady rise in repeat mandates, policy benefits released, and accelerated implementation of policies for acquiring existing stock. Additionally, product innovation, professional capabilities, and resource integration have contributed to the company's revenue growth. The robust order backlog and expansion of business through project management overseas have also played a significant role. On the other hand, revenue decline is primarily driven by intensified market competition in the project management sector, downward pressure on the real estate market, decrease in overall scale of project management industry, and tougher commercial terms. Reduction in government project management business, centered on affordable housing and shrinkage of land acquisition scale, have also contributed to the decline. Overall, the company's revenue growth is driven by a combination of internal factors such as product innovation and professional capabilities, as well as external factors such as policy benefits released. Conversely, revenue decline is primarily driven by market competition and downward pressure on the real estate market. Net income and profit margins. A tale of 2 years, the financial performance of a company has undergone significant changes in recent years. On one hand, net income increased by 45% compared to the same period last year, indicating a substantial improvement in revenue generation. However, when comparing it to the previous year's data is not available. On the other hand, profit margins have taken a hit. The gross profit margin decreased from 51.5% to 40%, while the project management services gross profit margin dropped by 11.4 percentage points. This decline in profit margins suggests that the company may be facing increased costs or reduced pricing power. The mixed signals from these metrics highlight the complexities of a company's financial performance. While net income has improved, profit margins have taken a hit, indicating potential areas for improvement and cost optimization. The company is indeed generating positive operating cash flow. This is evident from the financial summary, which states that the company is producing a net cash inflow from operating activities. Specifically on page 12, it is mentioned that there was a net cash inflow of Rm 112 million. Additionally, on page 45, the net cash flows from operating activities for the year 2025 are reported to be 111,899. Although the net increase in cash and cash equivalents on page 46 shows a negative figure, this can be attributed to other factors such as investments or financing activities rather than operating performance. Therefore, based on these figures, it is clear that the company is generating positive operating cash flow. The company's debt level and interest expenses have undergone significant changes in recent years. In terms of debt level, the gearing ratio has remained relatively stable at 0.9%, indicating that the company has maintained a consistent level of borrowings. However, this figure does not provide a clear indication of whether the debt level has increased or decreased. On the other hand, interest expenses have shown a notable decline. Total interest expenses decreased by RMB 242,000 from RMB 1,716,000 to RMB 1,474,000. Furthermore, interest expenses on loans from related parties also saw a significant reduction of RMB 200 $197,000, or 79.2%, indicating that the company has managed to reduce its interest burden in recent years. The company's performance varied across different segments and regions. The project management services segment performed poorly, with a decline in gross profit margin from 51.4% to 40%. However, within this segment, certain regions or projects showed strong results, with revenue of 1,361,194 RMB 0 and 1,640,743 RMB 0, and results of 315,015 RMB 0 and 546,749 RMB 0. On the other hand, the other services segment performed relatively well compared to the same period in 2024. In contrast, the other segment within project management services performed poorly, with weak revenue and poor results. The company has a history of paying dividends. In 2024, it paid a special dividend of RMB 0.1 per share, and in 2025, it paid final and interim dividends of RMB 0.24 and RMB 0.076 per share respectively. However, there is no evidence to suggest that the company has bought back shares through traditional means. Instead, it distributed HK $10,117,000, equivalent to RMB 9,253,000, for share award schemes, which does not constitute a traditional share buyback. Concerns over inventory buildup and supply chain disruption. The financial summary highlights two pressing concerns: inventory buildup and supply chain disruption. A staggering inventory backlog of 1.265 billion square meters has been reported, with a significant portion, 77%, concentrated in just 4 major urban clusters. This excessive inventory poses risks to the company's operations and may lead to inefficiencies, waste, and potential losses. Furthermore, the concentration of inventory in specific areas creates vulnerability to supply chain disruptions, which could have far-reaching consequences for the business. That concludes the financial summary for GREENTOWN MGMT. Feel free to comment below, and I will be happy to answer them when possible.